This week on Wealth Track, how to get the biggest stream of income from your retirement nest egg. Kiplinger's retirement income guru, Mary Beth Franklin, and top-ranked financial planner, Mark Curtazzo, tell us how it can be done. Next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter, and the Dreamin Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This week we are continuing our two-part series about retirement income. Now last week we talked about the changes that have occurred in people's plans and expectations for retirement as a result of the worst financial crisis since the 1930s and the hard times we've been living through ever since. Americans are understandably worried and cautious about the future. Those contemplating retirement are planning to work longer and have scaled back their retirement income needs. Several recent surveys confirm that baby boomers and younger workers have altered their thinking about retirement and their preparations during their working years. They are now willing to put more money aside for their future retirement and health benefits. But for all this uncertainty and unease, retirement is still a viable dream for many Americans. The financial markets have bounced back from the worst days of 2009, and employees' continued contributions to employer-based retirement plans have restored most workers' retirement accounts to pre-recession levels. In this second part of our retirement income series, our two experts have several ideas about how to boost income streams and how to arrange a guaranteed flow of funds during retirement. Our first guest is Mary Beth Franklin, senior editor of Kiplinger's Personal Finance magazine. Mary Beth is editor of Kiplinger's annual retirement planning issue and has been honored for her retirement coverage. And joining her is financial planner and investment advisor Mark Curtazzo. Mark heads his own firm, Macro Consulting Group, based in New Jersey, and he recently was named Advisor of the Year by Boomer Market Advisor magazine. I began our conversation by asking Mary Beth Franklin why we should be more concerned about the reliability of income in retirement than the return on investment.
In the past, people felt comfortable having all their money invested, believing that diversification would protect them from risk. It does diversify the risk, but it doesn't guarantee that they won't lose money. And here we had people who planned to retire in 2008 that lost 30% of their money because it was all in the market. This is a re-emphasis on where and how you have your money invested and when you start moving it around. I think one of the important things is about 5 years before retirement is a good time to make sure you have a chunk of your money, maybe 20-25% of your money, in something safe. It might be a CD, it might be a stable value fund. It doesn't even have to earn anything, it just has to be safe. Do not confuse return with a long-term portfolio and what you need right now. And then you can keep the rest of your money invested for growth, knowing that you have 5 years of cash to live on no matter what happens in the market.
Mark, 20 to 25% of my nest egg in liquid assets, even if it's not earning anything? I mean, for 5 years, what's your response to Mary Beth?
I think that if you're looking at people who have a very high percentage of their income from their portfolio is covering need, the predictability of income becomes critical. We have lots of clients that have a second home that they could sell. They have vacations that they've budgeted in. Some things that are discretionary, and if you have more of that, you can dial that down because those are toggles that you can shut off. On the risk avoidance piece, you want to control what you can control the best that you can. So if you have a much higher yielding money market that's paying 1% a year more than what your other cash is paying, it'll last you longer. So nothing is kind of tough for me to swallow.
Ideally, you want, say, maybe 2%. But right. Even if you can't get it, rather than chasing return with this money, keep in mind this chunk of money for the first 5 years in retirement should be free of market risk.
And we see situations where looking at where clients own what they own. We'll have a husband and wife, they have similar sized portfolios in their IRA, and they're 50-50 stocks and bonds, 50-50 stocks and bonds. And one of them has a fixed account or a stable value portfolio that's yielding 4%. And the other, their fixed income is in a money market earning 0.25%. Well, the simple solution to that is sell all the stocks and keep all of this spouse's money in the fixed and have all of this spouse's money in equities. $1 million, $500,000, $500,000. I have $500,000 in fixed, half of it earning 4, half of it earning 1/4. If I have all of it earning 4 and I have all of the stocks over here, I have the same upside with the stock, but my fixed income I've just doubled my yield on.
As long as I don't get divorced.
Well, you'll have a quadro and we'll split that up. We'll make sure that that gets evenly divided.
It's very important to look at integrated portfolios as a couple.
So a holistic approach, right?
And also your retirement money and your non-retirement money. Often, because so many people, virtually all their investments are inside their 401k plan or their IRA. And when that money comes out, it will be taxed at their ordinary income tax rate. Now, the bulk of their investments are probably for long-term growth. If that money was someplace else, it would come out at a 15% capital gains rate rather than, say, a 25% or 28% or higher. So when you get to retirement, could be a good time to look at both your retirement accounts and your non-retirement accounts and saying, are these tax efficient? And if not, maybe I can swap some of the investments, sell the CD that's in the brokerage account and use that to buy stocks. And then sell the stocks that are inside the retirement account and use that to buy CDs that are going to be, taxed at your normal income anyway. Right. Just to be smart about it, you can save a whole lot of money just by being smart.
Let me get back to the reliable stream of income, Mark, and I'm sure that a lot of your clients ask you, especially after the financial meltdown, is where can I find higher, safer income? What's your response to that?
One of the things looking at if they have the option of taking a pension as a lump sum or taking the pension, what we do for clients is we'll shop that. We'll say, here's what you can get in cash, and if we got that cash, here's what we could get in an immediate annuity that provides the same kind of guarantees as your pension. The fixed income side has gotten to be the most difficult part of creating a portfolio for clients for us right now because we don't want to buy long-term bonds. If you go out and buy 10-year treasuries today, the yield's below 2.5% taxable. And if rates go up, the value of your portfolio is going to get hit. I think one of the things that is very scary that we see coming in is people having long-term government bond funds that have been superstar funds for the past 3 years and 5 years in a declining interest rate environment. And I ask them, what do they think is going to happen with interest rates? And they say, we think they're going to go up. And if interest rates went up 1% on the fund they own, their principal would drop 18%. And they don't understand that. So pursuing income, cash flow, isn't something that we focus on as much as total return. If the bond's throwing off 6% and my principal drops 18%, I would have rather earned 0 on my cash.
But let me ask you, because you're still getting the income, if you're in treasury bonds, you get you get your principal, your full principal at par back.
Correct.
At maturity. So isn't that a fair trade-off?
Well, if you think rates are going up and you wait a year and you sit in the money market earning 1% instead of 2.5%, and rates go up to 3.5% the following year, you're confident rates are going to go up, and you wait on the sidelines. And the next year you buy that 10-year treasury at 3.5%. I'm getting an extra 1% a year for 9 years, and I only sacrificed 1% or 1.5% for 1 year off my return. My total return on that 9-year or 10-year period of time is greater if you're confident rates are going to rise. And most people don't own the individual bonds. They own a bond fund.
In which case you don't get it back at maturity. You lose in the principal.
And the manager could be trading out of those bonds, and that's a real, your total return hit is a real one. So
and I think one of the things Mark was pointing out is there's an importance to match up your income needs with an income stream. But that doesn't mean all of your money should be in fixed accounts to generate this income. You got to keep investing for growth with a chunk of your money. And I think people get so frightened, they think the market went down, I've lost so much, I'm just going to hold on to all that money. And yes, they have gotten rid of the market risk, but now they've got the inflation risk, and more importantly, the longevity risk, which is basically the risk of outliving your money.
1999 was the most difficult year in 20 years in my practice, which was a terrific year for the stock market because people didn't care at all about risk.
1999.
1999.
Right. Before the tech bubble.
The stock
crashed.
market had done almost 20% a year for 20 years, and bonds were doing double digits. So people didn't care about risk, and we were talking about risk, and it wasn't a very popular thing to talk about. And they didn't care about downside. They only wanted to know what the upside was. And I think that the pendulum has swung to the other side where people don't care about the upside. They only care about the downside. And that's, both of those are very unhealthy. Because if you're earning 1% or 2% on your portfolio and you need 4 or 5% cash flow, you're going to eat into your principal. And if you're drawing 5 and earning 2, I could tell you the day you're going to run out of money. And you need to die before that day. That's not a good financial planning strategy if somebody exceeds that. So,
but you know, there is a solution for that too. It's something called longevity insurance. Now, this is something that academics love and most consumers hate. The concept being, I buy a life insurance policy now, maybe at age 65, that's fairly cheap. It might be $5,000, $6,000. And it only kicks in if I live to 85. And at which point it's going to be a chunk of money, a lifetime income stream. Again, it's that use it or lose it. Oh, gee, I don't want to spend $6,000 if I might never use it. But what it does is it gives you an end point for how long your other money has to last. If I know my money only has to last 25 years, I can invest it accordingly. And then if you live to 85, this other one kicks in. I think this is going to become a bigger component of retirement income planning going forward. If you're going this route, you need a trusted advisor who can walk you through this.
Our research department, we have 7 certified financial planners. The woman who heads up our research has a master's in mathematics, a master's in physics. She's a CFA and was an equity analyst at one of the largest brokerage firms. Her job all day long is just doing analytics and saying, what's our upside downside and this strategy versus that. And something we would have recommended to a client 3 months ago has changed. All we do is the pre-retiree. That's our bread and butter. And so we get to have a much deeper knowledge of those programs and strategies where we're not trying to be everything to everyone. And we have a hard time keeping up with it.
We're talking strictly the investment end of things. But again, the average retiree has to think more holistically. And one of the best things they can do is test drive their retirement budget. If you make an assumption that you can probably live on, say, 85% of your pre-retirement income, and a chunk of that's going to be from Social Security, and a chunk's going to be from your personal savings. About 2 years before you retire, try it out. Try to live on 85% of your disposable income.
So let's say it's $8,000 a month, or let's say it's $4,000 a month, whatever it is. You try it out now. You reduce your expenses before you retire.
And then you take the money you're not spending and you save it. And hopefully you're saving it in your employer retirement plan. A married couple over age 50 can each put $22,000 away into retirement savings. So that's $44,000 a year a couple could save. That makes sense to max out that contribution, even if they have to dip into their savings for day-to-day expenses, because it does 3 things. It's maximizing their savings, it's reducing their taxable income, because this income is not included in their taxable income, and it's forcing them to stick to a budget. If they can stick to that for 2 years, they're ready to retire. And if they can't, they're not ready.
Can you imagine advising your clients to do that, Mark? Have you done it? Have you said, try out your retirement expenses now before you retire?
We have clients test their waters in lots of different things. Moving was one of the things that we talk about frequently. If they're going to be moving to a different part of the country because it's less expensive, go there. Go there off season, go there for 3 months. And this testing the waters, to make a permanent move, a permanent change, where it would be very difficult to unravel, sometimes that cost for testing the waters could far outweigh what you could lose if this doesn't work out. So we don't have a problem having the important conversations with clients. We're not always going to tell you what you want to hear, but we'll always tell you what you need to hear. And there's always somebody out there who will tell you what you want to hear. And having the clients and the individuals discern the difference between the two, it's very difficult. And I don't envy them in trying to figure out what's the best route to go.
So what do we need to hear now as pre-retirees or retirees?
Test the waters is a great mantra now. Test whether you really need to retire full-time. Is there a way you can either phase down on your current job or line up something else that might bring in some money that's going to occupy your time? Because once you quit, it's really hard to go back unless you're some sort of superstar and they want you as a consultant. Most people aren't in that position. If you're thinking about moving, try it out first. It's different to be a vacationer than it is to be a resident of someplace. Test the waters with this retirement budget to see, can you live on 85%? And if not, maybe you need to work longer and save more, because what's more important to you, the lifestyle you have now and to maintain it, or to quit what you may see as drudgery of work? If you can't reduce your lifestyle, then you're going to have to keep working.
So, Mark, what's a difficult, reality that you have to face your clients with?
Clients who wanted to help grandchildren with college or completely pay for college, people who want to stay in their home. I live in New Jersey, and property taxes and just maintenance on a house can be very, very expensive. Could be a couple of $1,000s a month for somebody who doesn't have a mortgage on their home to just maintain. So the reality of them potentially needing to do a reverse mortgage to tap the equity in that home. If you want to stay there, the only viable way may be to do a reverse mortgage, which is giving you income or cash flow off of the equity you have in this home. You may need to spend principal or eat into principal. And my conversations a number of years ago were, I don't want to touch principal, I'll live off of this, and I'm going to leave this wonderful nest egg. I'm having a lot more conversations with people who say, if I bounce my last check, you did the perfect financial plan for me. It's that balance.
We're spending our children's inheritance.
Right.
It's that balance of trying to get what you want now and have more immediate gratification, and still managing that tail end risk of you living to 95 and having these rising costs that eating into principal now could prevent you from being able to address.
And talk about this back to the future idea. In the old days, people would have mortgage burning ceremonies, and then we had decades of people flipping properties. There is a real movement going back to one of the triggers of can you afford to retire is, have you paid off that mortgage? Because if you do, that significantly reduces your cash flow needs. Now, certainly there's a trade-off. You're not getting that big tax break anymore. But in the long run, for a lot of people, it's a lot easier to live in retirement without a mortgage.
So that hasn't changed.
But we see people that are 65 years old getting a 30-year mortgage now because they want to stay in this home, or they want this home, and
right.
they would rather have the cash flow instead of having that money tied up in the property. So, I think everybody's situation is different, and people address those different emotionally, because somebody doesn't want to owe anybody anything, and some people are fine just paying the flow.
Getting back to the income question, eventually interest rates will go higher. So how do we get from here to there? What are you advising clients,
Well,
Mark?
We've shortened down the fixed income maturities on our portfolios dramatically. We've worked with some floating rate vehicles, and we were fortunate enough to get into some fixed accounts that had floors in the past, where people's rates have come down and they can't go below a 3% rate, and they've got liquid funds that are chugging along at 3%. So those combinations, we're keeping the powder dry on your safe money to eventually go back into the market. The one interesting thing we have conversations with clients all the time about is they have a bond portfolio that has 5 and 6% coupons on their bonds. And they said, well, you got these great yields, but the bond values are at 115 or 120. And if you look at the yield to maturity on those bonds, it might be 1.8% or 2%. So they feel good because they've got this 5 or 6% coupon, but they're guaranteed to have their principal go down over the next 5 years between now and maturity. They're going to lose $20,000 on that $100,000 bond.
So what do you do?
We're talking to clients about monetizing that. It's a capital gain.
Selling
the bond.
Right.
Selling the bond. It's a capital gain instead of this 5 or 6% being ordinary income. They might have capital losses because some people lost money in the stock market, I heard. And they can offset that loss with this gain and have that profit tax-free instead of taxed as ordinary income. There's wonderful opportunities, but people have to look at the total return, their yield to maturity, and not just what's the coupon and what's the cash flow.
Alternative income streams, aside from bonds, MLPs, master limited partnerships, REITs, and non-U.S. fixed income, what are some alternative income streams?
Pipelines.
You need to be creative. When money markets are paying 0.2 and longer-term CDs are paying 1.5, you have two choices. Go down in credit quality, go out in maturity. In the potential of a double dip, you don't want companies that are already financially having difficulty. And if you think rates are going up, we do. A lot of the smart money in the bond area think rates are going to go up. Buying longer term to get that coupon, your total return over the 7, 10, 12-year period that you're investing is going to hurt you. So look at this differently. Go look at a total return type portfolio and draw from it each month. And I think that you'll have greater opportunities for positive returns that are inconsistent with what your income needs are going to be versus lower quality or staying very short term.
This is another flip, again, of the traditional rules of thumb that investors are used to. We've always argued the importance of investing for the long term. And we're basically telling people, keep your money short and get ready for the next opportunity. So no wonder people are confused.
You know, that 4% rule of thumb, if I had half my money...
4% withdrawal.
Rule of thumb. If I had half my money in bonds and half my money in stocks and my bonds are yielding 7, that's giving me 3.5% yield. It doesn't put a lot of pressure on my stock piece to get me that 4% income. When they're at 1 and 2, it's a lot more pressure on the other side. Right. So it's different now.
The other thing we didn't get a chance to talk about, speaking of the overall portfolio, is the most dangerous thing a retiree can do is to be withdrawing too much from their nest egg when the market is down. Because if you picture that nice big nest egg and it's shrinking and you continue to take chunks out of it, when the market rebounds, you don't have enough left.
Right, you won't recover.
To recover.
I have a great example of this. We have 3 brothers that are 3 years apart. One retires January 1, 1997, buys the S&P index fund, takes 6% a year from the portfolio, $5,000 a month. His portfolio today is still worth about $1 million. The younger brother is 3 years younger, retires January 1, 2000. Same index fund, same $5,000 a year withdrawal. He has less than $250,000 left. And the youngest brother retires in 2003, 3 years later, puts in his $1 million, he still has $1 million. 2 of them are fine, 1 of them's almost out of money. And that is, same investment, same withdrawal rate. You can't diversify that risk away. That's a timing risk.
Right. One investment for a long-term diversified portfolio is something that each of us should own some of. And Mary Beth, immediate annuity is what you were talking for. It's specifically for a period of time.
Immediate annuity for a particular period of time, but at today's low interest rates, it may not be the best investment. However, the best annuity almost any American can get is Social Security. And the key is to know when to take it, how to maximize your benefits. And if you go to Kiplinger.com, you can read all my secret strategies of how to maximize your Social Security benefits.
Give us a couple of examples of just how to maximize your Social Security benefits.
For example, a married couple, if say the wife is the lower earner, she could take benefits at 62. The husband could delay his benefits till age 70 when they're worth 132% of what they would have been in his normal retirement age. That proves a bigger benefit later and for the surviving spouse. But when he hits the magic age of 66, which is the current normal retirement age, he can say to Social Security, I want half of what my wife is getting. So let's say she's getting $1,000 a month. He suddenly has $500 a month coming in, no harm, no foul. His own retirement benefits continue to grow at age 70. This is called restricting your benefits to spousal benefits only. Very few people know about it. It can boost a couple's household income by $6,000 to $12,000 a year without costing them a dime.
Wow. Kiplinger.com. So that's, I know there are others of those too. So Mark, what's your one investment for a long-term diversified portfolio?
Well, I think the best investment somebody can make for $12 is getting a subscription to Kiplinger's.
So on that note, we're going to have to end this, unfortunately, but Mary Beth Franklin and Mark Cortazzo, thank you so much for joining us on Wealth Track.
Thank you so much for having us.
One idea for steady income and a way to grow your assets is convertible securities. This week's action point, check out convertible bonds. These hybrid securities have both debt and equity-like features. Convertibles usually have a lower coupon rate than a traditional bond, but they offer a kicker that lets the owner convert to stock at a certain price. It is a conservative way to participate in the stock market while getting a steady stream of income from coupon payments. According to veteran fund manager John Calamos, whose investment firm specializes in convertibles, the aim is to achieve 75% of stock market upside with only 25% of the downside, while receiving a higher cash income than investing in most dividend-paying stocks. And on a recent Wealth Track, bond manager Kathleen Gaffney said she likes convertibles right now and owns them in the Loomis Sayles Bond Fund. One Morningstar analyst pick is Vanguard Convertible Securities. Morningstar recommends this actively managed fund for its broad exposure to global convertible markets. Next week, during one of public television's Pledge Weeks, we're going to revisit our popular program about the new world of alternative energy with financial thought leader Bill Paul. To watch this program again, please go to our website, wealthtrack.com, to see it as a podcast or streaming video. You can also watch us on your smartphone or tablet with our new Wealth Track app. Thank you so much for visiting with us, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sayles, investors seeking exceptional opportunities globally. Research Affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter, and the Dreamin Foundation.